Welcome to Euros Hartley's Finding the Front, where we get to know the people who front some of Western Australia's leading companies, providing you with real insights into the way they think and approach things, both in business and in life. So get the volume adjusted in your car or your headphones sorted and settle in for a great story. Here's your host, Tim Banfield.
Hey everyone, and welcome to Euros Hartley's Finding the Front. It is just fantastic, as always, to have you tune in. And what an opportunity we have in this episode. For those listening that aren't familiar with Euros Hartley's, we are a proudly Western Australian, diversified financial services company, listed on the ASX, stock code EZL. Our wealth management business, combining wealth management, strategic advice, and stockbroking, is built on relationships established over many, many years. If you'd like to learn more about Euros Hartley's and the financial services we provide, please don't hesitate to contact us or visit our website at www.euroshartleys.com. Now on to the main event. Our very special guest for this episode is Andrew Mitchell, founder and senior portfolio manager of highly regarded Sydney-based fund manager Ophir Asset Management. Founded in 2012, Ophir has grown to become a multi-billion-dollar small and mid-cap global and Australian-New Zealand fund manager. They manage money on behalf of pension funds, family offices, wealth management firms, high net worth and private individuals. Ophir's flagship Ophir Opportunities Fund has generated some 23% per annum net returns after all fees from inception in August 2012 to 30 June 2026, some 14 years. Andrew loves what he does. He lives and breathes investing. He provides some fantastic insights into what has shaped his career and his views across business and life in general. So, without further ado, it gives me a massive pleasure to introduce to Euros Hartley's Finding the Front, the founder and senior portfolio manager of Ophir Asset Management, and all-round great guy, Andrew Mitchell. Andrew, welcome to Euros Hartley's Finding the Front. We are really grateful you could squeeze us into your very busy schedule coming over from Sydney to Perth, and it's just great to have you in the studio. So thanks for joining us, mate.
Well, knowing that we're going to get some footy chat in, I made sure that there was plenty of room, extra time to talk about our amateur league footy.
Okay, well, look, you've got a great career, obviously, very accomplished in the area of funds management, and we're going to get to that with Ophir Asset Management. But one of the main drivers of this podcast, Finding the Front, is to really get to know a bit about your background and how it shaped you to get to where you are now. And I do know that you grew up in the mighty city of Adelaide. And
Mighty.
Mighty, yeah.
The mighty South Aussie.
How was growing up in Adelaide?
I had a very normal childhood. Lived in suburban Adelaide, rode my bike around on the weekends and loved playing footy and going and watching the Adelaide Crows, and that was my life.
Well, that
I
would have
didn't
been.
realise about funds management until I was probably 22 years old that it even existed.
Went to primary school. Did you find it easy at school?
No, I was probably just slightly above average student. I was more interested in recess and lunch, playing hide and seek chasey or something, or whatever game is the craze, Foursquare, whatever it was. I didn't have the greatest attention span and sort of got through with good grades, but I was not a brilliant student by any means. I was more interested in other things than school.
Yeah, I get it. What about your mum and dad? What were they doing at the time?
So fantastic for me. My mother's a social worker, and so she's looked after, work with a lot of Indigenous people and people who who didn't grow up with everything. And she had a good career, then had children and went back as a social worker because she could work part-time, and she's an incredibly caring person. So that was just fantastic having a mother like that. And my dad he's a businessman. He was public servant, but in the department that's all about growing South Australia, so he probably didn't do very well. But he was sort of similar to a funds manager, attracting investment into South Australia. But when he wasn't working and he worked really hard, he
Yeah.
showed me the principles of, like, I know my dad left for work every morning. He ate his Wheaties with honey, I think he had on them. And then he was off for work at 7:30 every morning. And
Yeah.
I would get dropped at school at 7:45 and there wouldn't be a single person. I remember this very well in primary school, and I was just the only person sitting there. And then I'd go to after school care, and my mum would pick me up after 5. I was basically the last kid to get picked up. The number of times I was sitting there with the carer by the phone, like, like trying to work out where my mum is, and I'm the last person there. And but I had great parents, and they taught me a lot of great values of family and friends, and tried to get me to study harder. I didn't really listen to them, and just love sport and all those things.
Did you take, ultimately knowing where you've ended up, did you take a bit of a lead from your dad in terms of being a businessman style of person within the Adelaide environment? Growing up?
I don't know if I said this to you before, Tim, but the greatest day of my life was Channel 9 Adelaide News, and they were in Woomera or something like that, and there was like some satellite being launched, and they had like some American businessman from Kistler Aerospace, or I think that's what it was, and then my dad was there, like in the sort of background of the news, and I was like,
that's
I'm
my dad.
That's my dad. And I was probably 21 when this happened. I was probably 15 or something, but it was a very sheltered life. But my dad did work very hard. And he was very focused on work, and he showed me, I guess, that dedication and the likes. And he always had time for the family as well. And when I went to university, all I knew was my dad had done commerce at Adelaide University and had done economics.
Yeah.
And I did the same thing. And my dad said, you can get a job in the government in Canberra, which was Treasury in Canberra. And he was like, that's a fantastic place to work. And I got the job as a graduate at Treasury. And, my parents were incredibly rapt that that kid that didn't study at school ended up doing well at university, and is sort of in the system now, and they've done their job, I guess.
That was your first role in Canberra?
Yeah, as a graduate policy analyst.
A graduate policy analyst, right.
Yeah.
And did you have any aspirations to do that other than bouncing it off your dad saying, Dad, what do you reckon of this one?
No, I think, as I said, my dad was just happy to find that I'd found some sort of career that opened doors. And that was the great thing about Treasury.
Yeah.
There were a lot of, when I went out to the workforce, it's like, if you've worked at Treasury, you have to have a level of intelligence, obviously, for them to take you on, despite what the Treasurer may have done recently and those sort of things. The people at Treasury are very smart, and some of them, or a lot of them, are very hard-working people who really care about Australians and are really thoughtful about policy.
Yeah.
And so that opened a lot of doors, the fact that I got to work and the exposure I got. Like, I was talking to people like David Murray, who was the CEO of Commonwealth Bank, as a graduate.
Yes.
And Morris Newman, who was the chairman of the ASX. These were the people I liaised with.
Yeah.
And it gave great exposure, and I got a great work ethic also at Treasury. Damien White was my manager, and he's ended up, I think he's a DepSec at Department of Finance now, and he was at Australian Office of National Assessment, so that's a intelligence agency. He was a fantastic leader because he just showed me, I guess, the quality of work that's required for the treasurer, who was Peter Costello. I remember the first you'd write briefings, and I was in banking policy where I started, so we looked after APRA, and so if anything to do with APRA and the treasurer, it's an agency that the treasurers and Treasury has, the legislation, the bills that go up, all those things that came through us.
Yeah.
I would send my briefings to my manager, Damien White, and they would come back with so much red ink on them, so many corrections. I didn't have enough. I need to have two spaces after every full stop, and there's grammatical error here, and my dot points have to be exactly the same, how the format worked and everything like that. And I remember saying to Damien, that this just seems also pedantic. and this was a big, I guess, point, and I've remembered it to this day, obviously. He was like, look, Andrew, if you have little mistakes or little sort of grammar mistakes or formatting that changes the way you do it, when the treasurer reads this, he's going to think that you've cut corners left, right and centre in all the thought process that goes behind the briefing. And so he's not going to believe it. And that's all our job is to do, is to give the best arguments towards the treasurer that are the most convincing first best policy. And so it was this real aha moment.
Yes.
That all the writing that we have to do and all our work and, building models at Ophir, and Paradice was good for that too. You can't have any little mistakes, because little mistakes show carelessness and lack of due diligence.
Yes.
And it creates a whole, I guess, paradigm of you shortcut. And so I learnt very early on at Treasury, no shortcuts, double, triple check everything, make it perfect so it becomes believable. And then, we'll talk about Paradice, but I remember Adam Harvey showing him a model that had circular reference, and he was straight away, what's this? And it was on tax, right? And I was like, that's just on tax, it doesn't matter. Like, we're valuing it on a before tax basis anyway. But he was right, because how could he believe that this whole model was going to be accurate if I've got a circular reference in there? And
yes.
It hurt me at the time, because I spent so much time building the model, but I was like, you're exactly right. I have to make this perfect. Otherwise, how can I tell you that we should be buying this company if I've got circular references in my model?
So it was a true foundation laying experience working there
at Treasury.
At Treasury.
It was fantastic. It was a great time in my life and learnt a lot.
Just take us through the steps from there.
So I went from CBA, so Treasury, I then went into the International Economy Division, where you're a proper economist and there's forecasting of international economies and the likes there. And then from that, I went to Commonwealth Bank, and ComSec had an economics team, and Michael Blythe ran the whole economics team from CBA. And so I became a part of that. Rod Maddock, who was an economist, and Commonwealth Bank that had an institutional equities business, he was actually the head of the whole research. And I said to him, geez, I'd love to get into equities research, because I could see that was a lot more interesting than writing about unemployment and those sort of things.
Yeah.
And he said, I've got the job for you. We're going to start a small cap team, and you can be member number one of that.
Oh, my goodness.
So that's how it worked.
At that point, did you have a passion or anything around small cap equities or equity markets per se, or just sort of a notion that it might be something you might be interested in?
I read about stocks in the newspaper, and you could see that the Fin Review, the interesting stuff was about companies. And I know people love hearing these stories about, I've always been so passionate about these things.
Yeah.
I'm just a passionate person.
Yeah.
Before that, I was passionate about economics, now and then I sort of was lucky that this small caps team was starting at the same time that I was like, I'd like to get into the equities research team. And then I was in small caps, and then, met obviously David Paradice, and that's how that happened. But it wasn't, I think a lot of people love telling these stories, how their grandfather walked them to the bottom of the ASX and they saw the tickers, and everyone goes, wow, this person was destined to be a fund manager. For me, I didn't really know what I wanted to do, and there's all these serendipitous moments, and it's just sort of led me this way. But whatever I would have done, I would have been very passionate about it, because it's just in my nature that anything I'm doing, I just find whatever about it is really interesting, and I love it.
It's interesting looking back on that, and there's a couple of observations. You could say that you didn't see yourself as terribly academic, but you got through.
Yeah.
You didn't really know what you wanted to do when you left school, but you found a spot.
Yeah.
And that's maybe, I think, sounds a little bit like an influence from your dad and how you ended up in Canberra. Looking at that.
A little bit. Yeah.
A little bit. But then the passion or the curiosity of mind just took you down this path, and here you are in equities.
I think if you saw what my life is and when I'm not doing not on stocks. Do you know where I am? I'm on Wikipedia down this massive rabbit hole about something that happened in the 18th century and learning about some count of some German province or something like that, and then having a look at a picture of him and go, gee, that was one ugly fella, that guy. I'm just randomly wasting time learning about the Count of Bavaria or something like that.
So do you love reading?
I like learning. Like I'm not like a fiction reader. I love non-fiction. I love history, all those things, and I love learning and understanding how things work. And I love that sort of that aha moment which you get in small caps where you figure something out.
Yes.
And yeah, that's what I like.
Yeah. And so there...
You're getting a lot out of me. I don't normally talk about this sort of stuff. It's getting very deep, and I feel like I'm on a therapist chair.
Let's just go back to CommSec, to the small cap equity team. You're number one employee. Obviously a great experience.
Yeah.
I want to start on that journey, right? Because this is where it sort of starts in earnest.
Yeah.
Because you go from there... And then, as you mentioned a couple of times, it ultimately ends up with Paradice. Yeah.
Well, yeah, and so what happened there, I was way in over my head. I didn't have the finance background, or I don't know how people pick it up.
This is at Commonwealth?
At Commonwealth, like writing research on small cap stocks. I felt when I was going into meeting management, they thought I was the dumbest person ever because I really didn't understand, like really how a balance sheet and cash flow interacted properly and putting these models together. And it was a real baptism of fire, but there was a lot of learning along the way, and then I sort of got through. But the reason that I got the job at Paradice was because I had an opportunity and I took it, where one of the Paradice portfolio managers was going to Melbourne. He said, I'd love for you to organise a trip for me. And I organised the trip, but not only that, I spent the whole weekend researching each company that we were going to and typing up everything and putting the numbers, what I thought where the market was and what I thought forecasts were, and just did all this. I don't even know. I look back and go, why did I do this?
Were you on the payroll at that point?
Not at Paradice, no. I was at Commonwealth.
You were
just writing research.
And a mate, was it a mate working at?
Well, it was Sam Lacornia. He wasn't a mate at that. I'd work with him delivering pizzas at age 17.
Right.
And then he gave me the opportunity, and then I sort of, just dove into it and did a heap of work for him, and he just went, okay, this guy's different to the average person out there. He's like, actually cares.
Yes.
I think I talk about a lot about the people we hire.
Yeah.
Like the people who care about doing a good job and like care about when they think they've done a bad job and how do they improve. And I think he saw that in me when I put this whole pack together for him.
Yes.
And then he wanted a person like that to help him out, and that's how I got the job at Paradice.
Was it hard to leave the Commonwealth Bank? And I could imagine at that point to have an opportunity with David Paradice was...
it was amazing.
It was amazing. Yeah, that's a great way of describing it. An amazing opportunity.
Yeah, so what had happened, I'd only been doing this for 6 months and I was getting heaps of job offers. It was not it was funny because Macquarie were also trying to hire me on sales at that time, and then there was another fund manager trying to hire me and as well. And I went to a person called Andrew Byrne, who's been out of this market for a long time, and he was always very friendly to me, and he was at a fund called MIR, I think now, MIR. Used to be at ING. An older guy, experienced, he was a UBS analyst, and I said, hey, I'm getting all these job offers, and I've got this Macquarie, and I've got and Macquarie was the millionaire factory back then.
Yes.
And this is before GFC. And I've got this Paradice, and he said, another one that I haven't forgotten, Andrew, this is so simple. Learn before you earn. You could always get a job, like at a Macquarie, at a broker. But at Paradice, you're going to be working with some very smart people, and you're going to learn more than anyone. And so that was, he told me the answer, and that's probably how I go about stocks. It's like,
Yeah.
do you figure out the answer, or do you figure out in a legal way someone who can help you make the answer? And he told me that. And then Paradice offered me the job, and he said, how much are we going to pay you? How much do I need to pay you? And I told him how much I got paid at Commonwealth Bank, which was not much. Like, I thought it was good, but it was not much, right, at all. And David sort of laughed, and he said, I'll pay you a lot more than that. and I said, and this is a big thing again, I said to him, I don't want you to pay me any more because I want to prove to you, like, how much I'm worth. And so if you can match that, that's fine. And it's funny, with all the people we hire now, we have to pay extra money to get them to come along and leave places. And I'm like, it's sort of, I wonder, versus myself and some other people we've hired, it was sort of like they, just to get the opportunity to work at Paradice, I was like, hey, just let me sign here. You don't have to pay me any money. I don't want to ruin this at the last moment because I'm looking for a pay rise. Just let me sign here.
Yeah.
And it was all that learn before you earn sort of thing. And so taking that principle was, been a very important one to me, like put learning and actually increasing the value of who you are first rather than trying to make as much money as you possibly can.
So you started there at 2007. Pretty pivotal time.
Yeah.
Because the equity market's on a tear. We're all going well. Property's going great. And then obviously we run into a pretty big correction.
You were getting a few touches for University of New South Wales, weren't you, back in? In the Amateur League?
I was probably getting a couple at that point. Yeah, no, I retired in 02, mate.
Oh, you retired in 02.
Thanks for thinking of me as younger. But going into that time with Paradice, just talk us through. I mean, you're going in there with, as you highlighted, some really smart people. David's obviously running a pretty unbelievable firm. They're growing their funds under management. They've got amazing clients.
Yeah.
And here you are. You're in the middle of it, or you're being introduced.
Yeah. So what I'd say about Paradice is there is some incredibly brilliant people there. Troy Angus, I often say, I've just always been just watching him as a younger person. I still think about, like I reference him a lot, like just seeing this person with so much clarity and seeing him talking to Adam Palmer, who he worked with back then, Matt Reardon and John Lake and Harvey and Rishi and David, and just hearing all these conversations. I was the young guy in the office. I was like one of the youngest in the industry. I was 26, 27, at this sort of time. And you just got to be a sponge and just listen.
Yeah.
The GFC happened. Okay, we haven't hit the GFC. This is all good times.
Yeah.
And so I was just learning as much as I could, but I was in over my head. They thought I was a lot better than I was. I'd only been doing this for 6 months, and I was in over my head. I had to learn very fast. So I was on the weekends working, building models, learning as much as I could, and just listening to as many conversations as I could, and looking up things on Google and all that sort of stuff, and trying to learn and reading books and stuff like that.
Yes. And that trajectory of learning from the best at the time, and you're just continually embracing, absorbing it all, right? You can't help but look back on that period of time and go, okay, in came the GFC, right? And would have had a big impact on your mindset at the time, watching the market crumble the way it did.
Yeah,
how did that happen? How did it just, without getting into the detail, but observations from that period of time?
Well, it's a bit scarier for me than probably the average person, because I told you that story about I was delivering pizzas with a guy called Sam LeCornu. He was a portfolio manager at Paradice, ended up being a portfolio manager at Paradice. I met him when I was 17, went to work for him. He was really good. He showed me how things went. And then Macquarie hired him to go run their Asian fund, and he moved to Hong Kong. And there was no one, there was just me on this fund that had, 300 million under management. Sam had gone, and then the GFC hits. and I'm just sitting there. I literally thought I could lose my job any day here. Like everything's so negative.
Yeah.
And so what I did was I just worked really, 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 really hard. I remember my weekends, my Saturdays, I was watching, sort of the music videos in the morning.
Rage.
Not that early, but the video hits maybe back then. But building models on companies and doing research, and then the midday movie would come on, and then the footy would be on, and I'd have a laptop on my lap all day and just work Saturday, Sunday, go into the office, work Saturday, Sunday. And it was the GFC was the best thing that happened to me, because that's when my learning just went crazy.
Yes.
And, it was, a lot of it was forced, but because I just didn't know, I thought I was going to lose my job. I didn't think I was going to lose my job, but I had no idea.
Yeah.
And so I just thought
there was a lot of uncertainty.
The only thing that the only thing that I could control was my inputs. And so they had to be at 100%.
Yeah.
And that was a big moment of my life, and I learned a lot. And I'm a product of the GFC. Just remember, here's this 26-year-old who's been in the industry for 6 months covering research, and probably then 6 months at Paradise.
Yep.
And then the world blows up.
Yep.
You're just sort of like, you become Chicken Little a little bit, that things go wrong. And there's a level of paranoia that I sort of have, and I'm not sure if it's a natural or it comes from that moment of the GFC, that things can go very wrong very quickly and all bets are off. And so that you take that approach to how you're looking at funds management, looking at stocks all the time.
Looking at that period of time, just the GFC, liquidity dried right up.
Yeah.
And I just wonder, if that had a role in your mindset, that maybe back then you sort of started to formulate how you started to look at stocks, and how Paradise at the time came out of that period.
Yeah, so the fund did really well out of that period, and a lot of it was fortuitous, because I'd cut, when I was in charge of that fund before the GFC, like only for 3 or 4 months. I cut any company I didn't understand. So I'd cut all these financials, because I was like, oh, this is complicated. I'm really over my head here. I got to cut these companies. So that was really good. And then because I'd worked through the GFC, I found a company, TPG, that obviously was huge. I was able to buy, or through Paradise, we bought 5% of the company, at 21 cents, 22 cents. And then that was in February of 2009. The March 9 was the bottom. And then I think by August it was $1.60 or something. So our biggest position, or the biggest position I had in that fund, was $1.60, and so the fund's flying out of the and it wasn't the only one. There were some others as well. So the fund did very well, and you really understood very quickly how things change, and the big sell-offs are opportunities.
Yes.
And don't get over exuberant in the good times, because you will see bad times, and the bad times is where you make your real, you can make your real money, and it's like picking up dollar bills off the floor.
Yeah.
And I really learnt that at that time. But also, that over exuberance, I think liquidity's king.
Right.
In small caps, if you get trapped in something that's about to fall 80% because there's no liquidity, you can't move out.
Yeah.
We need to make sure that if we've got higher risk stocks, that they've got a lot of liquidity. The lower risk stocks, we're prepared to go down. I see a lot of fund managers don't differentiate between that, and they get stuck in these lobster pots. But yeah, it was a very formative part of my life, and really set myself up and Ophir up through my experience back then in 2008.
What a great initiation and baptism of fire. And for the listener, you heard Mitch refer to lobster pot. So that's the classic pot where you can get in but you can't get out.
Exactly.
In Australia, in Western Australia, we call it crayfish.
I was going to say
cray pot.
Cray pot. Yeah, I actually had that. Yowie has a few cray pots going on. doesn't he?
Shout out to Simon Yo. So it's a great way to then segue that you were with Paradise, and then obviously you've been there for a little while, and about 4 years, and you decided that it was time to go and do your own thing.
Yeah.
Now, and your co-founder Stephen.
Yeah.
Just Ophir Asset Management began in 2012, but that idea of leaving and getting started obviously is a big step. And maybe you could just shed a bit of light on that, because it sets the foundation for the next phase.
Yeah, it's not as big a step as you think. I think the fund had done very well.
Yes.
Right? And when a fund does well, it creates other issues with people in it and other things. And so David understood those issues. And when we left, David was in full understanding that we were going to leave. And he actually said, I understand this, and I'm going to invest money in your fund right from the start to show I support. And this is, it's unfortunate that these things are happening. It's not your fault. It's not our fault. This is just what happens when funds do very well. But there was a group of industry funds that knew us, knew Stephen and I well. And so we had 3 industry funds with $50 million each that invested pretty well right from the start. There was actually the original one that was meant to be invested before all the other 3 was the one that didn't invest. But we had $150 million from very, very early.
Which is a great place to start.
Well, when you have a fund that's, I think, it was the number 1 performing equities fund in Australia by a long distance on a 5. So we'd been there for, I think, like 4 years, 10 months or something like that. And Stephen had been there for 2, and I'd been there for the full time running that fund. And David was, that's 100% his or their track record.
Yep.
And they knew us anyway, because Paradice is obviously has got a very good relationship with a lot of industry funds, that it was very easy for them to invest. They're like, here are these guys that have done this huge outperformance over the last 5 years. It's the number 1 equities fund in Australia, and we've got a chance at investing with them when they start.
Yes.
It just went bang, bang, bang. And then, we're off and running.
I want to come back to it later, but that hunger of an early stage manager is often attractive to investors.
Yeah.
And that would have been right where you were at that point.
100%.
But I can tell right now you've still got the hunger.
No, my hunger. It's funny because when I started, I used to start work at 8 o'clock in the morning, and this is Ophir, the early days, and I'd finish at 6:15. Now I start at 6:15 and I finish at 5:15, so I can get home to put my daughters to bed and have dinner with them.
Fantastic.
At 6 o'clock. But I'm actually working bigger hours now.
Yeah.
And I'm more intense than I probably was back then. But it's sort of being forced upon me, as we were talking earlier before the show. It becomes more competitive. The market becomes more efficient every year. And Steve and I talk about it. We have to get better every year, and the firm has to get better every year. And for a long time, it was Steve and I started at 8, then it was 7:45, 7:30, 7, 6:30. Now it's 6:15. We start every day, and Stephen's probably in at about 6:30, 6:40, and we're the first in the office, and we start that's the precedent for everyone else.
Start the day rolling.
Yeah.
We'll get to the changing market. It's quite interesting to discuss that. I wanted to just talk about Ophir Asset Management as the business that was starting. Now, I know that people have probably heard this before, but Ophir, the name comes from the first gold discovery in 1851, about 30 kilometres northeast of Orange.
You don't have that written down on a piece of paper right in front of you, do you?
Well, I wrote it down because I just thought.
I saw you bring that piece of paper out.
I thought.
Here comes some facts.
I just thought, what a great way to establish. It was the first gold discovery. I mean, I didn't know that at the time.
There you
But
go.
it's quite a famous gold discovery back in the mid-1800s.
Yeah.
So tell us, what started the name Ophir?
Do you really want to know the full story?
Well-
Stephen and I are like, right, we're doing this business. Stephen's like, I think we should be called Pursuit Capital. And I was like, I really like the name Hawkeye. And he hated it. He's like, Hawkeye's from MASH.
MASH.
That's bad name. I was like, yeah, it was a good character. And then then I came up with the idea where I said, let's just find pivotal moments in Australia and world history and see if any of them work. And then Stephen came back and he goes, I found one. Do you know where gold was first discovered in Australia? And I don't know, Ballarat. And he's like, no, Ophir, just outside Orange. And there's a East African oil and gas exploration company called Ophir. So I'd seen the word before
Yes.
and then did the research, and it's from the Old Testament, and it's where, and then we actually just created the narrative that small caps, it's the because what happened with the gold rush is the people who are first to the gold rush are the ones that make all the money.
Yeah.
And then all the Johnny-come-latelys that come at the end, these guys are moving on to the next gold rush, wherever that is. And the guys who are finally moving over from California to Australia, they're at the back. And this is the same as funds management. There's the guys that we're always selling our stocks to after we've made the easy 20, 30%. Then there's people that we're selling those stocks to. You don't want to be the person that's buying the stocks off the people who made the easy 30%.
So it's the first mover advantage.
100%. But we created that narrative after we came up with the name. So it's not I'd love, as I said, this is a therapy session. So I'm telling you, this isn't the BS.
But it's it's an unusual name, so what, it's quite interesting to hear the background of it. But there were certain principles that you and Stephen had in mind in the formation of this business.
Yeah.
And it's like companies have their values.
Yep.
And I'd say these principles are your values in terms of managing other people's money.
Yep, 100%. And, we are doing these presentations right around Australia, and the first thing I talk about in every presentation has not changed. And that is we have all our personal money outside of our house invested in the funds. We have incredible alignment. As Charlie Munger says, you show me the incentive, I'll show you the outcome. The Ophir staff are the second largest investors in the fund after one of those first industry funds. And we will be number one, with just all that compounding. I'm putting in more money this month. I put in money last month, and I've just got a direct debit just going straight into the fund. But the idea is, and it sounds pretty corny because I'm not some super wealthy dude or anything like that, but this is our own family office. And while I have the staff working for me as my family office, managing my own money that's invested in all the funds, the staff are all heavily invested in the funds as well. And I know one of them, and I loved it when he goes, and I heard it secondhand, one of them said, Michael actually said, you realise Andrew's working for us, effectively, because they've got the money invested in the funds. They share in the performance fee. And it's like, that Andrew's work rate, he's working for us as much as we're working for him. And I love that analogy because if we're a whole family, and this is our whole family office of all the individual families that are the Ophir staff, we're all working for each other, managing the money. But that alignment for the investors who are right alongside us is phenomenal. And when you really, really care, because, hey, it's something bigger than just a business we work in. This is us managing our own family wealth and all those things. That's when you get good outcomes. And that was I don't actually give that whole speech when I do these presentations, but the next point is when you have that level of alignment and you're in small caps, you have to constrain the capacity of the funds. You cannot let them get too big. And so we will close funds. We're going to soft close our global small cap fund in the not too distant future because it's getting obviously good inflows given the performance, and we can't let it get too big.
Sure.
So it's important.
I'd like to...
And that hasn't changed. And that was to your point. Sorry, Tim, just finish this off.
Yeah.
We were talking about that in the very first year when we saw our very first investors, which included those industry funds. that was the pitch.
Yeah.
And it's still the pitch today. And Lonsec or Zenith, one of those guys who are the big ratings houses, I'm pretty sure it was Lonsec, and I just loved it because they're obviously very good at what they do. They said we would have to say there's no manager who's been true to what's their label and who they are with constraining capacity as you have been over the 14 years that you've been going.
Well, that does align. I'll use that word align, but that was one principle, but also you want to invest in good businesses.
Oh, okay. We're talking about business principles.
No, but it's like when you're starting a business like Ophir, asset management, the two of you got together and said, right, well, what are the things where you're going to be bound by? And one of them is alignment.
Yeah.
Obviously very passionately and very transparently aligned.
Yeah.
For investors and staff and just to keep on the straight and narrow. But, what were the other things that you said, right, we're a small cap manager. What's our bread and butter?
Well, the bread and butter didn't really change from Paradice. It's not like we went and said, hey, we used to look at value companies at Paradice. Let's go and look at growth companies.
Yeah.
We just did exactly what we were doing at Paradice. It was same companies, but
under your own stewardship.
Exactly.
Yep.
But what the principles are that they have that they had at Paradice as well is we are looking for companies that are growing, taking market share in hopefully industries or that are structurally growing themselves. So if you're taking market share, you're obviously doing something well.
Yes.
And if that industry is actually structurally growing and has tailwinds, it's growing faster than GDP, you sort of got that growth on growth element and you're obviously doing something well. This company is going to go well. Now, the only sort of, I guess, caveat on that is, and this is the hardest one, the company needs to be doing it at a greater rate than the market is expecting. And so there's two elements to that. We have to work out, okay, what is the real trajectory that this company is on?
Yes. And
there's obviously a lot of work that goes behind that. And then we have to work out what is the real trajectory that the market thinks it's on. And that can be quite difficult at times as well. And that is, if there's a sausage that's the Ophir sausage, that's how it's made.
Yeah. And
we speak to management teams, but that just gives us the idea where we make our money is getting edge, and you get edge by talking to customers, customers that are used whichever this company's products, and they say it's a fantastic product and we're going to buy more in the future. You talk to competitors. Some of the TPG investment.
Yes.
I had a day to make that decision, less than a day, half a day. I didn't even have time to build a model. There was a 5% line that was going for sale. I called Bevan Slattery, Clive Stein over here in WA, Mike Malone over here from IINet and maybe even Vaughan Bowen who was later Unity Wireless. And I said, hey, I don't even know. This company's got amazing numbers. It was called SP Telecom at this time. I'm looking at this result. It's phenomenal. Who's this David Teo guy? Is he any good? And he is the best. He is so good. He's, and they explained he's cheaper than Telstra, taking a lot of market share. So if a competitor who should, normally they say bad things, all these guys just said amazing things about TPG.
Yep.
That's unusual. Likewise, another big one, you speak to I've got a 100% hit rate with this one. You speak to an ex-staff member. I worked there a year ago. This is why I worked there and this is why I left. Quite often, didn't get along with the CEO. I was a senior exec and didn't get along with the CEO. And so you've sold all your stock now? Oh, no way. No, I'm hanging on to this one. The company has got, years of doing very well ahead of it. And, the CEO, for their faults, has got all these good things as well. I just didn't like working with them. When people should say bad things and they say good things, customers, competitors, suppliers, you go through that whole network, and when they're all saying the same thing about a company, it all adds up. You go long, and that's when you make money.
It helps execute.
And that's just the process that we have each time, but it requires hard work. And I know I spoke to you earlier today, and I probably shouldn't say about this one maybe in the podcast, but there's things that we do, and I would imagine, when we're talking, and this one is talking to the retailers that sell a particular product. Anyone who's listening to this podcast on this about this company could call the retailers and ask them how good their product is. There's only 10 of them in Australia. And I know I'm the only one who's done it because I do it to the retailers and I ask them, have you ever spoken to anyone in funds management? And no, I've never spoken in a funds management before. It's a very technical product. And they're saying it's the best product that this company's ever released, the new product they've come out and how amazing it is and how the waiting list is so big. The market doesn't know this. No, it doesn't know this yet. Or maybe I should say, it's probably not a bad thing. So the company's Codan, it's gold detectors. They've just released a Gold Monster 2000. There's not very many people who sell this. These are gold detectors. They find gold. They're selling into Africa. You can ring up the 10 different distributors who are sellers of these around Australia and ask them, what are these? Hey, Tim, you sell these gold detectors. How good are they? And they will all tell you that the latest one is just the most amazing detector that this company has ever released. You do a lot of these sort of calls and you work things out, and we've got real edge, and now everyone who listens to the podcast has got edge, that the new Codan detector is absolutely amazing, and there's a waiting list, and the retailers think that it should have a lot higher price tag on it, even though it's double the price of the last one.
Very interesting.
But that's the stuff we do to get edge, right? And it's not hard, but you'd be surprised how many people just don't do it. Well, how many people, all the investors in Codan, no one else has done it. It's easy. I just look them up on Google. Who sells Minelab gold detectors? Boom, here's your list of 10. Call 088 to beep, 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 beep. Hi, my name's Andrew Mitchell. I'm a fund manager. You sell gold detectors. What do you think of the new Minelab detector? It's amazing. It's the best detector we've ever seen. We've got a wait list of 2 months. We wish they just had more of them. It's just people are finding gold they've never found before, and we're getting people in Africa calling us up every day trying to get them. Okay, thank you very much for your time. Money, but no one does it.
Fascinating. It does make logical sense, but to your point, you've got to actually take the time out to do it.
Yeah, and we all get caught. And I see myself, I think, Malcolm Gladwell talks about, people who say that they're busy. I could spend a day working, right? And I actually do nothing that actually gives you an edge. But I'm looking at all these stock results and all this great stuff. But then all you have to do is pick up, Google who actually sells these detectors and ask them, are they any good?
And
but no one's done it.
Well, yeah,
and that's edge. But that's edge.
Space.
And so you can be busy, and the gold price is sort of a bit iffy at the moment, and there's other things with Codan that are maybe not so good, and the valuation's high. So I'm not saying people go run out and buy it, but we're doing this sort of stuff on every different company that we look at, and we're just trying to get edge. Work out things with the information that's readily available to everyone else. If you're just prepared to sort of put yourself out there.
It's a bit like monitoring foot traffic in shopping malls, and things like that. Or
I'll tell you a funny story. There's a very well-known company with a billionaire founder who's invested in our funds, and he was trying to work out why we do so well. And I was telling him how I bail up retail, like the girls behind the counter at particular retailers, and just ask them how that particular store, so they've got 250 stores around Australia or whatever it is, and just I know the best stores, and I just go and ask them, how are you going, and you get a flavour just going from one to the other, you're getting a flavour that they're going well, or they'll tell you the new range is not actually selling that well at the moment. Or the new range is doing amazingly. And he absolutely loved it because this person who everyone will know and everyone would have shopped in his shops before, he's like, we do the same things. He was talking about his family holiday just went on with his wife, and when it went into a different country. And the great thing is there's stores there of competitors and things, and how he goes in and does the exact same thing, and he absolutely lit up hearing it. And then, he's a founder, I'm a founder, and we sort of bonded over that whole founder mentality, that this is the stuff that sort of makes money, that when you're a founder, you work out on your family holiday how you can pop into that store and ask them how they're going and doing all those sort of things. And he's saying, I do the exact same thing, and managing my wife and family as I take a detour to on the family holiday to walk into a shop. And I'm like, 100%, I've done that many times. My wife's not happy with me, but we have to go to Strathfield in London to go and see this store and ask the person how the new range is trading and all that sort of stuff.
So let's just focus a little bit on the first fund, the Ophir Opportunities Fund. Yep. And I think by what we've just discussed, you get a good feel for the thematic around that fund. And it has done extremely well. I mean, it's generated 23% per annum, net returns after all fees, from August 12, which is when you started, to June 26, which is some 14 years. Yeah, do you step back and go, I'm genuinely very proud of that?
No.
Or do you feel like, this is just the beginning?
Because I don't think it's the beginning. I just stress that this will be the last year that I'll ever be able to get those returns, and I'm always stressed about what's
around the corner.
What's around the corner, but what is next year's company that doubles or triples, and I have to find it, and what is it in the portfolio? I can't see it at the moment, and I'm constantly stressed. There's never a point as a fund manager, I don't think, and I'm sure, like that founder I spoke about, he's a bit older now, so he's probably had time to think about this, but there's never a time you think you're executing at 100%. I'm talking to our investors at the moment, and I'm not over the portfolio as much because I'm not looking at it 100% of the time every day, because I'm talking to our investors. I'm stressed about that. Yes. So I'll get back tonight to my hotel and be over that. And you get those returns, it just creates bigger expectations. And in my head, how do I continue to do that, And 10 years ago, I would have been stressed like this, and I'm still stressed today. But last year we did, 22.5%, and the average is 23%. So we're still hitting about the average.
Yeah.
But there's never a time that I feel that we're doing really well. We can always get a lot better, and we have to. And if we don't get better, we're going to get eaten up by the new young people out there who are hungry and want to make their mark on the world.
Which draws us back to that hunger question, right? And when the starting fund managers, the fund managers, as you just pointed out, are out there, they just want to get their first 100 million under management. Here you are with multiple billions.
Yeah.
Like the hunger, I can see it in your body language, is still really driven to be the best. But what keeps you going? I mean, apart from the hours at the office, the calls to potential investments, like what's the driver? Is it still that intrigue, or is it from that you had when you were back being a policy analyst, in essence? You want to keep growing.
Here's a really interesting story. I actually told this last night for the first time in a long time to a lot of investors. I won't say who told me this, but it's a very well-known Formula One identity who knows Lewis Hamilton very well, and people will know who this person is. And through investment, I got to actually spend a couple of hours with this guy, and I asked him a heap of questions, just opened him up and talking to him about Lewis Hamilton. And he said, the thing about Lewis, and this is when he was top of the top, he's the most insecure person you will ever meet. He thinks that God, I think, has given him this special power, but it could get taken away at any moment. And he's so paranoid about that he works harder than anyone else on the grid to be the best. He knows the reaction time of the young people. His are getting slower, and he can't improve it because it's just a thing about getting older. Yeah. So he has to get as a better driver, and he's got that continued angst. And I'm not an elite, I'm not the Lewis Hamilton of funds management. I'm not trying to make that analogy. No. I think I love that sort of, and I think a lot of the people at Ophir have it, the sort of the imposter syndrome, the self-doubt, these sort of element. You know what I'm getting at. It actually leads to a growth mindset. You're always trying to get better, and you're never actually happy with where you are, and you think the next problem's around the corner. And I'm not the only person who has it at Ophir. I think I picked the rough diamonds to come work at Ophir. They generally haven't gone to the best schools, and they haven't had the easiest life, sort of thing. But it comes to great outcomes, dotting I's, crossing T's. You're always worried what's going to go wrong. You underestimate your own ability, which is a lot better than overestimating it, where you make big mistakes. And I reckon that's the best way of sort of describing Ophir and the hunger. And it's not just me; it's everyone, right? I know a lot of this has been about me. Ophir is an organism in itself, and it's that sort of comes. And I think a lot of people are like that at Ophir.
The business itself has grown. Obviously, the flagship fund is the Opportunities Fund. You then decided to go global, and basically replicate the same model, but on a global stage.
Yeah.
Did you have any apprehension at the start on actually investing globally from Australia?
Yeah, big time. Like, what right do we have to take on some really smart Americans as fund managers?
Because this was, around 15, 18?
No, 2018.
2018.
But it was probably 2017. I think maybe I can't remember when we all started. Because there was a bit of
formulation.
There was a big build up. The track record, though, is the first day we started investing. Was that day? It's not there was a year of mulligans and then starting again. It was, but we told every investor, because our Australian funds were closed in 2018. We'd already raised, like $1.5 billion or whatever it was back then, $1 billion, whatever. And we had told everyone, because everyone was saying, "What's the next fund? What's the next fund? Would you do a micro-cap fund?" And we said, we'll only do another fund if we think it's going to make us better at what we are currently doing. And what we like about global is it certainly makes us better, but we would have to do it the hard way. I'm not, as you can probably tell, I'm not motivated by money. I'm motivated by winning and sort of, having to fuel my sort of imposter syndrome and, like low self-esteem sort of thing, to have to continue to do well, to have a place in this world. The US, we had to do it the right way, and the right way meant you have to get a team in the US, and that's very hard because you have to get Australians who want to move, and then they have to stay there for their life. In the US, and we've just built methodically, slowly. We didn't go out there and raise as much money as we possibly could. We did, we obviously got off to a good start. We just did it methodically and slowly, and we improved the process, because in some ways the US is in global, because we invest in the Western world, right? UK, Western Europe and US, and most of it's 2/3 the US. The US, it's like, what do we call it? It's quite hard. Like it's easy in some respects, but then it's a lot harder in others. You get absolutely crucified if you make mistakes over there. Hedge funds go hard. There's lots of short reports. If a stock misses, they're off 50% on the regular.
Yes.
Like, you got to be dotting your I's and crossing your T's. There's a lot of hard work there, but there's a lot of opportunity. There's, as I say, all these companies like Zip Money's looking to list in the US, and I'm like, no, you're rare in Australia.
Yes.
This company of this quality with this growth into the US. In the US, you're not rare. There's so many good companies over there, and if you make a misstep, there's no one there to buy you, because they just move on to the next good company. They don't need a company that's going through a challenging time. And so there's so many great companies to find, but at the same time, you make mistakes, it really hurts.
And that has evolved, though. I mean, you've managed to refine the art of investing with a US base now? You've got an office in Denver.
Yeah.
Yeah, and that's just gradually progressed. I mean, the global fund the Global Opportunities Fund had a phenomenal last financial year.
Yeah.
Up 31.8% again, net of fees.
That's a good memory.
Look at that, and look at that in light of the current climate and and how the Australian fund's gone. It's been a great FY26 for the company. That brings us to the modern day current view, sort of.
Oh, right.
And I mean, I think for the listener, we can see where the business is now currently positioned. But as an investor in this current world, it's a bit challenging. It's a bit tricky. There's a lot going on. And I noted that you've just come back from the US. So you've done a lot of company visits over there and with the US office, and obviously got your finger on the pulse here in Australia. How are you seeing things in the current climate? And
in Australia or the US?
I think we'll start with Australia, but we'll further expand that out to the global. But and look, we haven't got all day either, so I'm conscious of that. But
if you want to rant about the latest tax changes, you've come to the right place. I was going to give you the Treasury analyst in myself talking about us becoming more of a socialist country, and how it becomes a catchphrase of the coalition, and I don't like it, but aspiration. The US attracts the best of the best because if you put in there, you get rewarded for it, right? And so you're attracting the best talent to the United States.
Yes.
And what Australia has done is, don't come here if you're any good, because we're just going to take from you as much as we possibly can, and we're going to reward people who turn up.
Yeah.
And it's the opposite to who I am as a person, and it's the opposite to what I think as a great economy.
The entrepreneurial culture.
Yeah, exactly. Yeah. Now, we are a fantastic country because the US is, you look at the homelessness. Like my wife, people ask, will I ever live in the US? Well, there's no way my wife is ever living in the US unless I'm worth $1 billion one day and I can live in this, the Upper East Side in some penthouse or something. There's no way she'll live there. The homelessness, horrible. The access to healthcare and all these things, it's horrible. They don't look after the the people, and it's very much run for the 1%. And so I do value very, very much the country that I'm in, Australia, and what we do for everyone. But I think that we should be rewarding aspiration, as the coalition says, entrepreneurialism, attracting the best talent to Australia, and really encouraging companies and everyone to invest in themselves and take risk, and invest in other people and take risk. And that's what a really good economy is. And that's my rant for what it is, for what it's worth.
Well, thanks for sharing.
I don't think everyone just told everyone what they already think.
It's important, and but I think when I was looking through, one of the things that I observed about Ophir is the transparency on reporting in terms of your monthly newsletters, and also there's a number of posts on LinkedIn just to, giving different views and that sort of thing. I've found it quite interesting reading. One of the things that came out of one of your LinkedIn posts was you took an observation around graduate jobs, saying that engineering, and I'll quote it, engineering, computer and information science, exposed, and humanities and social science grads are proving more resilient.
Yeah.
And the quote was along the lines of, our real worry is that the junior staff lean on AI to think for them.
Yeah.
They never learn to problem solve or critically evaluate the answer. And that becomes a skill in itself.
That's me talking from an Ophir point of view, because making mistakes, going and learning things, and that whole process is where you get to be a fund manager like myself. And if people are just going to AI to get the answer, It's great for me because there'll be competitors are doing that, but I don't want anyone at Ophir doing that. They have to go through the whole process to be able to put it all together, because if everyone thinks like a robot, we're going to get robot results.
Which is a really interesting point, you
Yeah.
know, in today's world. And I think it'd be well received for people to hear that. But coming back to it, you know, let's hear what you've got. Let's just start with the macro environment.
Oh, the macro.
Yeah.
Okay, so in the US, you know, I could be wrong here, but we've got a Fed decision coming up, and we'll find out probably when people listen to this. We don't think Warsh. Yeah, if you think about Warsh, he's come in. He was very transparent. He will be data dependent as the new federal governor. So when he was hawkish in his first meeting, it shouldn't have been a surprise to anyone, because at the time the oil price was high and urea prices were high and things weren't great. Now, by the time this goes to air, Trump could have said something and the oil price will be over $100 and everything's changed, and I'll look silly. But the oil price in its current state will be temporary. You just have to look at the futures, in the futures market where it's currently sitting, that the market doesn't think like that. When Warsh comes out this next time, he's looking at temporary higher oil prices that have come down, and we've seen them come down very quickly, which isn't a reason to move interest rates. We'll be having a look at the US economy and whether we're expecting that either way he won't be as hawkish as he is. He's reacting to the data as he sees it. So from that perspective, there's been the breadth in the market has been coming right from the start of the year. We're seeing the manufacturing index, the PMI, actually starting to grow again, which is fantastic. But small caps EPS, which is really the domestic US economy, is being revised up, and it's been revised up since the start of the year. That's not normal, and that's really good for the US economy, but also for small caps. And so what we've now seen is small caps are re-rating compared to large caps, which is fantastic news for us especially. The AI trade, obviously there's a huge amount of leverage that went into buying all those semis and memory, and as we're talking now, they've just started to melt down and come off a lot. We have only ever held an index, or just under an index position, which is around 8, 9, 10% of our index in the semis and memory, because we've got no edge on this big, huge, you know, these margins they've never had before, some, you know, valuations that have never been had before, with growth that's never been had before in a very cyclical industry. It seems like a recipe for disaster. We haven't got any edge there. So the returns, and you said, you know, we did 32% last year. That has not come from semiconductors and AI, but for hedge funds to get massively long this sector, what they did was shorted software, shorted healthcare, and shorted all this other range of companies. And so as we see the semis come off, we're seeing the broadening healthcare, the med tech ones especially starting to rally. You're seeing the SaaS rally. It's a lower quality rally because it's short cover, but we have seen some broadening. We need to see the oil price come down to see the consumer go up again, but we saw signs of consumer doing better as the oil price came off last time. So we're quite, what's the word I'm looking for? We're quite bullish on the US economy to the end of the year, especially considering Trump and the midterms, and we know he's going to be really focused on the economy, rocking and rolling into the mid years. So we're expecting that this breadth is going to continue, notwithstanding if Trump opens his mouth and starts, you know, more conflict with Iran. At the moment, it's simmering down, but we're one missile or one drone off another a conflict. So, it's hard to talk at any time into a recorded podcast.
No, absolutely, and understand.
But yeah, we're quite, we've got a positive view on US stocks to the end of this year.
Yeah, okay. And then Australia?
Australia's a bit harder. We've been all pushed in, or the market has been pushed into a very narrow field, because we've got rates high, discretionaries. Without going on that rant again, we've got rates going higher because the Feds are taxing wealth. But then they're spending more. So rates are going higher. It's hurting the consumer. We've got housing, obviously, that's struggling with all the taxes and things like that. The best quality companies in Australia for a long time have been software, and that's still got huge question marks. So everyone's been forced into this very small subset, either resources or a few sort of AI-related businesses. Contrarian in me thinks, okay, this is as bad as it gets. Now's the time to just sort of start adding to the discretionary stocks. But from what we're seeing at this point in time, there's not very many companies doing well. And to what I said earlier, that makes it quite challenging in terms of finding those companies that are doing better than the market expects.
And the foreseeable future doesn't look like it's going to change too much?
Well, as long as the federal government continues to spend and can spend as strongly as they are and push rates higher, then it's not good for the Australian economy. Yeah. But, the market always wins, and this will all be an opportunity, and it won't be as bad as this. It's just we're finding it a lot harder to find those companies that are winning outside of the resource sector.
Okay, yeah. Thanks, Andrew.
I need to give you more of an upbeat. I'm pretty upbeat on the US. We've got lots of opportunities, and finding stocks there is a lot easier than Australia at the moment. I hope I didn't depress you. Thanks, Andrew. I wanted you to cheer me up here and get me fired up into...
I can see that you're not totally despondent about the Australian situation, but you can see there's better opportunity.
You're in WA. You're fine. You just invest in resource companies, and that's going all well. That's all going well.
Look, I'm conscious of time, but I just had a couple of quick questions. Who in your career, who's the fund managers you started out looking up to?
Oh, looking up to?
Who were sort of the people you aspired to be?
Oh, aspired to be? So, do you mean like Peter Lynch, or do you mean like
globally, domestically?
Domestically, the people like Paul Hannon. He was a bit scary, but then on my first day at Paradise, I was actually at the the Burwood Casino here. Yeah, and we were going with Euros to the Northwest Shelf tour, and I remember waiting for a taxi at or bus to pick us up or whatever it was at 4:30 to go, and then Loops gave me this really nice pep talk. He's like, you got the job at Paradise, well done. The thing about us guys in small caps is we're all nice guys, we all get along, so welcome on board. And he was nice to me, and I always thought the way he went about it, he was very smart, and he's now retired, Paul Hannon. I think guys at QVG, they're sort of more contemporaries. Guys at Ausbil, they're pretty good. QVG, I look, L1 is listed now. Like Rafi does an amazing job there. I don't know how he makes so much money, but he's got some magic touch that I certainly don't have. They're probably the guys that I don't really look at the L1 results other than the fact it's listed. Yeah. But, the QVGs, Ausbils, they're the sort of ones that I look at. There's probably a couple others I've forgotten there that I see how they're going, because I think they're pretty good investors. That would probably be the answer. Yeah. The David Paradice, getting to work at Paradise, that's the obvious one. Yeah. But most of I was the youngest guy when I started. I was 26. There was no other fund manager my age, so most people are retired now.
Yeah, yeah. But it's just good to get an insight into how you're seeing it currently. And I suppose from that perspective, if you're a young fund manager coming out, you know, an Andrew Mitchell at 26, 27, you know, looking to start out, how would you look at it now? Have you changed your views a little bit on the industry?
When we started, there were 40 fund managers in the survey. There's now 150. So there's a lot of people. Oh, and I didn't say Matthew Fist at Fire Trail, and the guys at Maple Brown Abbott, Matt Griffin, who I know really well. They're two other guys I really, really rate highly. And the reason that's important, because if you're starting out now as a Andrew Mitchell fund manager, well, you've got Matt Fist and the guys at Maple Brown Abbott, Matt Griffin. They're out there raising money at the moment. They've got really good numbers and they're really smart and they've made a lot of mistakes that they've learnt from.
Yes.
I'm not saying that they make mistakes, but that's a really, you need to have done that, and that's what experience is. It's going to be harder to raise money. We were the only guys out there at the start. It was like no one had started a fund for a very long time. There were very few boutique funds, so it was a lot easier for us when we started. So what would I say to them? If you're asking me for advice, I think this is what Charlie Munger... Have you heard this one?
Go on.
Charlie Munger said... who was it, Charlie Munger or Warren Buffett said, if you're asking me for advice, you probably shouldn't be in the game. I can't remember how he did the analogy, but it was basically...
Along those lines.
Yeah, you started this business... how did you do it and all this sort of stuff and wanting to learn? And it's like, if you're asking for advice, you're probably, you're probably making a mistake right from the start. But maybe that is a good, sorry, I've actually forgotten the analogy completely, but he had sort of, this one that if you're sitting there and asking us what to do, that's what's different from all those other billionaires, because they're just out there doing it.
Yeah.
They're not...
Yep.
They're not sitting there pondering all these different, should I do it, should I not? They're just going
straight in.
They're just going straight in. So what the advice I would give is, go in. Don't half it. Don't get a backstop like a person who gives you capital. We own the fund 100%, right? We don't have a backer.
Yeah.
Put yourself in. Feel like you could lose everything. And it's only when you could lose everything that you get to actually do very well, because you have to put it all on the line. That's what makes you the best. And that was what we did. I don't think we really went into that, but I put all my money into the fund when I started. It just had to work. That was the nature of it. So that would be my advice: go all in and don't half. I was going to say a rude word, but don't half. Sorry, I won't say
no regrets.
I was going to say half-ass. That's not a bad word, is it? Don't half-ass it. No regrets. Get in there and go hard.
Yeah.
And don't look back.
Excellent. Now, I'm conscious that you had a stellar football career.
Please, I did not tell everyone who's listening to this. I did not tell
at the Glenunga
this.
Rams Football Club, award-winning life member, and...
He got all this from the website, by the way. I did not tell anyone. I did not tell Tim this thing.
But I must say, footy's had a big role in your life, and I wanted it to leave it till last.
Yeah, okay.
I've got the 2 points to complete our catch-up, but one of them is football and one of them is family. And I know you mentioned work-life balance with your family is extremely important, and how life's adjusted to that.
Yeah.
Footy's also had a massive role in your life, not only from the people you've met and the teams you've been a part of and the enduring nature of it. But tell us what you've taken out of sport in general and what it's taught you that you've been able to put into life.
Footy was the first thing that I found out I was good at something. And this was after I left school, and that award you say where I won the association, that amateur league, the league I was in.
I mentioned this before the chat, and he said don't mention it.
But then I've just dropped it in the conversation, casual drop in. No, and it wasn't the top division, like it was the first grade team, but not in the top division in the amateur league in Adelaide. And I just never thought I could ever win anything in my life. I was just sort of like, I participated. And then I think that gave me a whole new sort of mindset, that if, you really put in, and then just seeing, all the people in the team respect me and, and all those sort of things. It was just and the great thing about playing, as people would know, have done amateur league footy, you get to just, get to mingle and get to know all these different people. And I really enjoyed that amateur league. And it's funny, my dad's the same. He's really into that footy club. And I live for that on Saturdays, just checking the score and watching it on YouTube, their games. And Glenunga knocked off Salisbury North, who are top of the Division 1 Amateur League in Adelaide. They knocked them off by 80 points on the weekend. It was a big win, and that made the rest of my day pretty. You'd be surprised. It's sort of stock upgrades. It's up 25%. Glenunga wins by 80 points versus the top team. I don't know what's better. It's a thing. It makes me really happy just seeing something that I guess it was feeling a belonging of that team and that
club,
seeing that too, and that club. Sorry, I should have said. And that belonging of a club is something that I value very much. So I really enjoy just seeing, even though I'm not big, involved in the club as much as I used to be, it's just really good seeing them do well. That's a part. And I think you asked about family and everything. I've got 3 children, 2 beautiful daughters and a 6-month-old son. And I try to be as present as I possibly can. They make me so happy. They make me laugh. The middle one especially. Found a photo, and unfortunately for her, she looks a lot like me at the age of 2.5. It's unfortunate for her. It's just, I love spending time with the family, and that's
wonderful.
It's a big smile on my face.
Yeah,
every time I see them.
Wonderful, fantastic. Well, look, that's a good place to sort of wrap it up. But I must say, look, on behalf of Euros Hartleys, congratulations on a to you and the Ophir team for an outstanding 14 years so far, and it's only just starting by the sounds. Just listening to you talk, it's so obvious that you're just scratching the surface in a way. You feel, I can tell you're excited.
I'm just, as you can hopefully see, I'm a pretty passionate guy. I love what I do. I love the human interaction, and I've got the best job in the world. I know it. It's just the best. Getting to have people, probably everyone's tuned out at this stage, but people actually wanting to hear me talk is just, it's pretty incredible. I'm just some average dude from Adelaide who tried hard. That's it.
Oh, look, we certainly do appreciate the time that you've taken to come and join us, because it is a whirlwind tour through Perth, and I know you've got functions on left, right and centre.
Yeah.
But, thanks again for taking the time, Mitch, and it's always a pleasure.
Yeah, thanks very much, Tim. Really appreciate it, and thanks to the broader Euros community. I really, really rate your research analysts and the whole team, and I think it's of the teams that's really impressed us at Ophir over the last couple of years that I think are doing a great job. It's the Euros Hartleys team. If they're not number 1, they'd be number 2 or 3 out of all the teams that's doing the best for us. So we're really happy with the relationship, and thanks again for the whole Euros just being there.
Good on you, mate. Thanks again.
Brilliant. Thanks very much.
Cheers, Mitch.
Thanks for listening to Euros Hartleys Finding the Front. This podcast is for general information purposes only. Please check out euroshartleys.com for more information. Euros Hartleys holds Australian Financial Services Licence 230052.